Hey everybody, my name is Alex Merced from alexmerced.com, and I want to talk more about derivatives. But this time, instead of talking about risk-based derivatives, I want to talk about credit-based derivatives. Now, most of the ones you know about are the mortgage-backed securities. And what they did is they helped get credit for housing. The way you would do that is that the traditional way you would get a loan is that a bank would have depositors. Okay, so I would offer you 6% on your savings account. You would come deposit your money. I would go lend it to someone else for their mortgage for like 10%. The bank would make the 4% difference, and that's what helped pay for the bank's operations and whatnot. Now, as interest rates have dropped, people don't really want to save money anymore. Why save money when you're making like 0% in your savings account? So there's a lack of sort of lendable savings. So what's sort of filled that gap are what's a category called asset-backed securities, which mortgage-backed securities are one. So what you do here is you're sort of doing it the opposite way. You make a bunch of loans. So essentially what you do is you'll go into the money market, because most people now who save their money in very short-term vehicles like money market funds, stuff like that. Very safe, very low return. The problem is the money can only be lent out for like a day, 2 days, 3 days. So I'll go out into the money market and use different arrangements, such as repurchase agreements, commercial paper, different short-term financing mechanisms, ability to borrow that money for like a day, 2 days, 3 days. Borrow that money. So let's say I borrow $100 million in this short-term money market. What I'll do is I'll go make a bunch of mortgages with that money for 30 years. Okay? So I'll make all these sort of, so I'll borrow that money for, let's say, 0.2%. Okay, in the money market, because you're borrowing the money for a day, it's really cheap. So I'll borrow the money for 0.2%, and then I'll go take that money, lend it to other people for 30 years for, let's say, 6%. Okay, so now you have that spread. I make those $100 million of loans, and then what I do is I package them into a trust. And how often do people pay their mortgages? Once a month. So every month, money is coming out of that trust from people's paying their mortgage payment. So then what I do is I take that $100 million trust and securitize it. I create a new security, which we'll refer to as a mortgage-backed security to keep it simple. And when you buy this from me, you're buying a piece of that $100 million worth of loans. So every month, when people pay their mortgages, a part of that money will go to you. So the idea is by selling these mortgage-backed securities, I've now gotten the $100 million back that I borrowed from the money market. So I pay off the loan to the money market. People have gotten their mortgages, and then we found investors who bought sort of these package loans. And the reason they prefer to buy the package loans is because you have a diversified portfolio of mortgages. Because if you lend to one person, you have the risk of that person losing their job, you lost all your money. But if you buy a basket of mortgages, the idea is that maybe one of them may default on their mortgage, but a lot more of them will pay their mortgage than not. Hoping that. So how well these securities work out is based on how good the mortgages are. So yes, some of those securities that crashed in 2008 were made with really bad mortgages. Okay, it's kind of like, but does that mean mortgage-backed securities are bad? No. Okay, it's like pizza. If you make a pizza with rotten grapes and, well, I don't even know why you'd use grapes on pizza, but rotten tomatoes, rotten cheese, it's going to taste really bad. But because somebody made a bad pizza doesn't necessarily mean all pizzas are bad. Okay, pizzas are really awesome, and pizzas can be made with anything, any kind of toppings. It's pretty good. Same thing with asset-backed securities. And what this does, it allows money, it allows people who need the money, more people who want to get a mortgage, to get money that wasn't available before. Because the people who did eventually buy those mortgage-backed securities, they weren't willing to make a loan to one person, but they felt more comfortable making a loan to a basket. And I borrowed short-term to initially create the basket and then lend it to the people who were willing to buy the basket. Okay, and again, that's I'm giving you a play-for-play by how this works. So companies like, most of these companies you see advertising on Facebook saying, get a small business loan. This is what they're doing. They borrowed from the money market. They're making like a bunch of small business loans for like $10,000, $100,000. I mean, again, you'll see these ads all the time on Facebook. Get your small business loan. Get credit for your business right now. Okay? And what they do is they package that like $100 million of those small business loans and then package into asset-backed securities, which they sell to longer-term investors who would rather buy a packaged product with lots of loans, so that way it's diversified instead of making you that specific small business loan and take the risk with just you. Okay, so this allows that small business owner who couldn't get credit more easily, even in the traditional banking environment, it was hard to get a small business loan. It allows them to get credit they otherwise wouldn't get. So all that money that's floating around in derivatives, it's going to small business owners, it's going to car loans, it's going to credit card loans. These are all the kinds of things that are being packaged into these asset-backed securities, or ABS. Okay, so it's not just being gambled. All this extra money sitting around, supposedly, is floating around in these kind of markets. A lot of it's sitting in the money market, being lent to create these products in the first place, or they're sitting in mutual funds and different institutions that are buying these products as long-term investments. But the bottom line is, at the end of the day, there's a loan to a business owner. There's a loan to someone for their car. There's a loan to someone for their house. There's a loan to somebody underlying this whole derivatives market, especially in this credit side. So you have the side that help investors offset risk, so that way they're willing to make more investments. And then you have this that helps make it easier for people who normally wouldn't be able to get credit to get credit. So financial derivatives play a very important role in making the economy work. And it can be tough to see because it's technical. But it's very disingenuous to sit there and say that all the money swishing around in the financial markets is just pure gambling. It isn't. It's complicated, but it's serving a purpose. Now, there are things that are distorting incentives, distorting our ability to predict risk, and that goes into a bigger conversation about what are the economic signals that people have to help predict the future more likely, because whether these securities do well or not are depending on whether those loans do well. And so hopefully people started the right businesses, hopefully people bought the right car that they can afford, bought a house that they can afford. But again, all that comes down to, what do we think tomorrow's going to be like? And if we can't predict what tomorrow's going to be like reasonably okay, then all that stuff falls apart. But again, that's based on our economic signals, prices in the market, well, the policy environment. So that's why uncertainty is a bad thing, because then it makes it harder to determine what are those good places to put money and get money moving. So my name is Alex Merced from alexmerced.com. Hopefully you found this very interesting. Share this video with friends. Have a wonderful day, and thank you very much.